All right, folks, here's a new term for you today. If you are just getting into syndications and trying to figure out all the terms that are included in the documents that you're seeing, one of the most common and important terms that you should look out for is the preferred return. I'm going to read off the definition from CrowdStreet because I think they do a good job of defining it, and then I'll explain a little bit more in layman's terms. So preferred return is a profit distribution preference whereby profits, either from operations, sale, or refinance, are distributed to one class of equity before another until a certain rate of return on the initial investment is reached. And so the way that I would describe this is a preferred return is like a hurdle rate for the sponsor, the operator, to reach and give preference to you before they get paid. So, for example, if it's a 6% preferred return, that would mean that 6% of all distributable cash flow coming out of the property is given first to the investor, typically annually, before that operator, the sponsor on the deal, would get any payment. And after that hurdle rate, then there is typically a split. So I've often seen like 70-30 or 80-20 split. So 70% to the investor, 30% to the sponsor or the operator in that deal. And so it's important to know what you're getting, what they're telling you that they're going to give you. Preferred returns have sort of declined a little bit in the years, over the years, just because the market has changed so much. And operators need to get paid something, and so that's part of why they'll set this up, because they want to give investors the first, the first money that's coming out of the property, because you are risking your money. And then after that, that's when they get paid. So it really is incentive for them to do a good job, deliver on what they're saying that they're going to deliver on, execute that business plan so that they can eventually get paid on after that, that hurdle rate. So there also might be some other fees associated with the deal, like the acquisition fee. So there is some time and money and work that goes into finding these deals. It's actually a lot of time and money and work. And so sponsors are typically charging some type of acquisition fee. I've seen around 2, maybe 3%, and they're risking their earnest money. There's a lot that goes into that. And so that there is typically going to be an acquisition fee. And then there's also typically an asset management fee that could be 2 or 3% of the revenue, say monthly or quarterly, coming from the property. And so again, they need to be delivering on the results that they're saying they're going to deliver on, because there won't be much revenue coming out of bad property. So they're not going to get any type of asset management fee if there is not revenue coming and generating, regularly from the property. So one other fee sometimes we'll see is a disposition fee at the sale of the asset. Some sponsors will take that as well. I don't see that as much, but it just depends on the deal. So keep an eye out for some of these fees, keep an eye out for the terms, and for just the layout of how these sponsors are making money and how you're going to make money, because obviously that's most important.